Something big is happening in the silver market right now, and most people still haven't fully realized it. Because while many investors are focused on short-term price movements, there are deeper structural shifts quietly building in the background. And these shifts could push silver prices much higher over the coming years. Let's start with one of the most important signals, the current stage of the silver bull market. There's strong evidence suggesting that this bull run may still be in its early phase. If we compare it to past cycles, especially the 1970s, silver didn't just rise slowly, it moved in powerful waves, building momentum, consolidating, and then exploding higher. If a similar pattern plays out again, the upside potential could be far greater than what most people expect today. But beyond historical patterns, the real story is happening in the physical market. Take a look at the current situation with global silver inventories. One of the key places to watch is the COMEX, a major hub for silver storage and futures delivery. Right now, the amount of silver that is actually available for delivery, known as registered silver, is extremely limited compared to the total demand in the system. In fact, the ratio between potential delivery demand and available supply has reached extremely high levels. What does that mean in simple terms? It means that if a large number of investors suddenly demanded physical delivery instead of settling in cash, there wouldn't be enough silver to meet that demand. Now, in normal conditions, most contracts are settled in cash, so this imbalance doesn't immediately cause problems. But it reveals something much more important. The system is highly dependent on trust and paper settlement, not physical availability. And over time, this kind of imbalance creates pressure. Because if confidence shifts even slightly, it can trigger a rush toward physical silver. And when that happens, prices can move very quickly. Now let's take it one step further. Based on current trends, the rate at which silver is being drained from available inventories suggests a long-term tightening of supply. At the same time, global demand continues to rise, not just from investors, but also from industry. And this is where silver becomes even more interesting. Because unlike gold, silver is not just a store of value, it's a critical industrial metal. It's used in solar panels, electronics, electric vehicles, and advanced technologies. So while supply is tightening, demand is expanding from multiple directions at once. That combination is powerful. And historically, when supply constraints meet rising demand, price moves tend to be aggressive. But supply depletion isn't the only factor at play. There are also potential global events, unexpected shocks, that could accelerate this process dramatically. Events that could push silver prices much higher, much faster than anyone expects. And when you start looking at those possibilities, the picture becomes even more interesting. Now let's go deeper, because the real upside in silver doesn't just come from supply and demand. It comes from what are known as shock events. These are unexpected developments that can instantly change how markets behave. And in the case of silver, even one major event could send prices significantly higher in a very short period of time. Let's break down some of the most important scenarios that investors are quietly watching. First, geopolitical risk. Think about major global choke points like the Strait of Hormuz. This region is responsible for a massive portion of the world's oil supply. If there were any serious disruption there, whether due to conflict or political escalation, it could trigger a major energy shock. And when energy prices surge, inflation fears rise, currencies weaken, and investors rush toward hard assets. That's where silver comes in. It acts as both a hedge against uncertainty and a beneficiary of industrial demand tied to energy and infrastructure. Now imagine this happening alongside an already tight supply situation. That's when price moves can become explosive. Second, the possibility of a breakdown in physical delivery systems. We already talked about the imbalance in the COMEX, but what happens if that system is pushed to its limits? If, for any reason, physical silver cannot be delivered as expected, it could trigger something known as a short squeeze. In simple terms, this happens when too many participants are betting against the price, and suddenly they are forced to buy back at higher prices. That kind of move can accelerate extremely fast, and historically, it has led to some of the most aggressive price spikes in commodity markets. And here's the key point. You don't need a complete failure of the system. Even a partial disruption, even a delay, can shake confidence. And once confidence starts to crack, markets react quickly. Third, supply chain disruption. Silver doesn't just come from one country. It's mined and processed across different regions, many of which are politically or economically unstable. Now imagine a scenario where major producing countries begin restricting exports or prioritizing their own domestic industries. We've already seen hints of this behavior in global commodities. countries are becoming more protective of their resources. And when that happens, global supply tightens even further. At the same time, demand keeps rising. That imbalance pushes prices higher. Fourth, industrial demand shocks. Silver is one of the most critical metals for modern technology. From solar panels to electric vehicles, from semiconductors to advanced electronics, the global push toward clean energy and digital infrastructure is accelerating, and silver sits right at the center of that transformation. Now imagine a breakthrough in technology that requires even more silver than expected, or a sudden surge in production across renewable energy sectors. That kind of demand spike doesn't just increase prices gradually, it can create sudden gaps in supply, forcing buyers to compete for limited material. And again, that leads to sharp price moves. But here's what makes all of this even more powerful. These events don't need to happen one at a time. They can overlap. A geopolitical shock combined with supply disruption, or rising industrial demand combined with delivery stress. That's when markets shift from normal conditions into something much more volatile. And historically, those are the moments when silver performs the strongest. Because silver doesn't move slowly in those environments, it moves fast. It overshoots expectations, and it catches most people off guard. Now, all of this raises a much bigger question. What happens if governments themselves step in and change the rules of the game? Because that possibility might be one of the most important developments of all. Now, let's talk about something that could completely change how silver is priced: government involvement. Because once governments start treating a resource as strategic, everything changes. We're already seeing early signs of this shift. Silver is no longer viewed as just another commodity. It's increasingly being recognized as a critical material, essential for energy systems, defense technology, and industrial production. And when something becomes critical, governments don't leave it to the free market anymore. They step in, they regulate it, they secure supply chains, and in some cases, they even influence pricing. Now imagine a scenario where major economies like the US, Europe, or Japan begin coordinating policies around critical minerals. Not just for rare earths, but also for metals like silver. This could include strategic reserves, long-term supply agreements, or even price support mechanisms. And one concept that's been discussed is the idea of a price floor. In simple terms, that means setting a minimum price level to ensure stable production and supply. If that happens, it removes downside risk from the market. And when downside risk is limited, capital starts flowing in aggressively, because investors know the floor is protected. At the same time, supply remains tight and demand continues to grow. That combination can create a very strong upward trend. But there's an even bigger shift happening in the background: a global competition for resources. Today, critical materials are being treated the same way oil was treated in the 20th century. They are strategic, they are limited, and they can be used as leverage. Countries are already competing to secure access to these materials. And one of the biggest players in this space is China. China controls a large portion of global processing capacity for many critical minerals. That gives it a major advantage in supply chains. On the other side, Western countries are trying to reduce that dependence. They're investing in domestic production, building new supply chains, and forming international agreements. But here's the reality: these changes take time. And during that transition period, supply remains tight. That creates ongoing pressure in the market. Now add one more layer to this: currency risk. If global currencies continue to weaken due to inflation, debt, or monetary policy, investors start looking for alternatives, assets that can hold value, assets that are real. That's where silver becomes even more attractive, because it's not just an industrial metal, it's also a monetary asset. It sits at the intersection of both worlds, and that's what makes it unique. When industrial demand rises, silver benefits. When financial uncertainty rises, silver also benefits. Few assets have that dual advantage, and when both forces come together at the same time, that's when you get powerful market moves. So when you step back and look at the full picture: tight supply, rising industrial demand, potential global shocks, government intervention, and increasing competition for resources, all of these factors are pointing in the same direction: higher pressure on silver prices over time. The only question is not if things will change, but how fast it will happen once momentum really starts building.